a lot of people say dividend investing is only for the older investors.
Regardless of your capital, I personally feel that it's better to start as soon as possible.
Dividends payout actually acts like a bonus or even like a passive income.
Yes. Struggling to keep up? Welcome to the FOMO Fix. A lot of people say if you're young, you should focus on the high growth stocks. But is this really the only best way for us to build our wealth? Hi guys, welcome back to the FOMO Fix. I'm Hazelle from the Joyful Investors, your navigator on this journey to financial empowerment. And in today's episode, we're going to challenge the idea that dividend investing is only more suitable for the older investors. Could it actually be a smart way for young investors to also consider using dividend investing to help them to build their wealth? To help us unpack all of this, I've invited Willie, Keng and Xin Yi to join me today. Welcome guys, and introduce yourself.
Hi, my name is Willie Keng. I'm an SGX Academy trainer and I write on a financial blog called DividendTitan.com. I currently invest for myself and my family and some close friends.
Hi, I'm Xin Yi and I'm currently doing full-time marketing in a finance-related company. So I've been personally investing for about more than a year right now.
Alright, so maybe let's start off with the basics first, right? So let's have Willie to help us break down what exactly is dividend investing.
Maybe I'll just kick off from a story, right? So there's this story which I've read like years ago, and it's a company called the Dutch East India Company. So in 1602, it first started as a publicly traded company. And what happened was that, it had ships sent all across the world, especially in Asia, to trade, spices, silk and so on. And every time their ships come back to dock, it's like collecting cash payments. Each ship which came back to the dock, it's a form of dividend payment. And this company, for 180 years, has been paying out close to 20% dividends every single year to its shareholders, to its investors. So during that time, they have made their investors one of the wealthiest people during that period. And that's what dividend investing it really is, right? I mean, we don't own ships today, but we are basically buying into strong businesses, accumulating businesses that are able to pay you dividends year after year. And this is really what dividend investing is.
Let's hear from Xin Yi as well. So Xin Yi, when you hear about this term dividends, right, do you feel that they are slow, boring, or you find them actually quite interesting?
So actually, when I first come into this term dividend investing, actually I thought that it was interesting because before I got into like investment, I was actually looking at like commercial property investing. So I wanted to have like a passive income, right, or like bonus. And dividends payout actually acts like a bonus or even like a passive income.
Yes.
So that's what got me curious and started learning more about dividend invest.
What kind of portfolio makeup or how much of your capital do you actually allocate into dividend stocks?
Because in my current work nature, I also need to know about like stocks or like investments. So the first project that I had was like related to REITs. So that's when I started getting into like dividends investment and stuff. But then as I started trying more and like trial and error on different stocks, I realized that actually maybe it's better for me to have like a substantial amount first before I go into dividend investment. So that's something like I am actually like looking at right now because I'm still quite young and I think to me, I want to build a portfolio towards like long-term investment or even for retirement and to beat the inflations, right? So I think right now that is something that I'm still like struggling to balance.
Yeah. Between like growth and dividend.
Correct.
Right. So that's a very valid point because when it comes to dividend investing, I guess the other very common term is growth investing, right? So Willie, maybe you can share with us, how does dividend investing compare with growth investing, and how or why might an investor be interested in the dividends over the capital gains under growth investing?
That's something which I actually get very often. Growth investing is basically looking at, companies, smaller companies which are growing very fast. So they could be like your Amazon when they first started out, or when Facebook when they first started out. So they grow their revenues very fast. They might not have profits, or they might be making some losses. So there isn't really one form of sustainable profits. When it comes to growth investing, you want to invest in these companies where you have a potentially large addressable market. So that's something which you want to look at. And most of the time, they are usually disruptors in their own market. So you try to change the whole market dynamics with the whole businesses. And as a growth investor, what you are looking out for is that 800-pound gorilla in that portfolio. So you might have 50 to 100 of these growth stocks, but you're just betting on that one, that one small handful of stocks which could really give you that strong multi-bagger to sort of pull up your whole portfolio. Because if you think about it, for growth companies, not many of them they survive. So in fact, maybe 1 in 10,000 companies which first got started, they may not survive in the long term. So that's really pretty much the whole idea of growth investing. You need to have that kind of technical knowledge to really understand what are some of the technology or the products which these companies are using. Now, on the other hand, for dividend investing, it's slightly different. So rather than looking for the 800-pound gorilla, what you're trying to look for are the flying elephants. So big companies where they can still continue to grow. And you are looking at businesses where they have been around for many, many years. I mean, if you take one example, one of the best performing stocks in the US is actually a tobacco company called Ultra Group. And they don't have fancy technology. They are not disruptors of the market. Yet, if you had invested $1,000 in one share of Ultra Group, today that $1,000 would have turned into $2.6 billion. So that's a period of about 100 years, right? From 1925 until today. So dividend investing, the big difference here is, like what Xin Yi mentioned, you are looking for that steady compounding growth of both of your capital and your dividends. And it might not be looking at the fast-growing businesses where there are huge disruptors in the industry. What you're looking out for are companies where they are giving you that predictable profit. So every year, that these businesses, they are able to pay you profits every year. And at the same time, from this profit, pay you a share of dividends.
All right. So for young investors who are looking to get started on dividend investing, right, how can they go about picking the top or the best dividend stocks? Any metrics that you can share with us, really?
There are a couple of key focus or key metrics which I tend to look at. Number one, I want to be able to look at whether the companies, they are able to grow their revenue on a consistent basis. So growing revenues,
very important.
Growing profits, exactly. And then being able to produce your free cash flow. So free cash flow is the amount of cash which they make from the company. You minus off any of the capital investments which they need to make to maintain the business operations.
Yes.
So every year, if there's a positive free cash flow, that's one positive sign. They can't have very high borrowings or high leverage. And the reason why is because in downturns, you also want these companies to continue paying you dividends. Because at the end of the day, the whole idea is to focus on these companies which pay dividends. Because paying dividends is one form of business excellence, right? It's not easy for companies to say that, hey, I want to pay dividend tomorrow. They have to meet with their board of directors, their managers, and then they say, okay, we decide to pay these dividends. Of course, when they decide to pay these dividends, it's always with the mindset that the business have to be predictable. They know that these profits are already steady, and therefore they're able to pay these dividends on a long-term basis. Because the moment if they stop paying dividends, then it might send a negative signal to the investors.
Right.
So these are some of the metrics which I tend to look at.
I think they are really definitely very good ones that investors have to check out, right?
Yeah.
Seeing yourself when you were doing your selection of dividend stocks, were those some of that you also look at as well?
Yeah. So actually, I also do, like, apart from looking at the growth, I also do look at, like, maybe the dividend payout ratio. So what is, like, the healthy range, maybe 30 to 50%. I mean, my thought process was that if a company can pay out regular dividends, so it can actually indicate that the company is having this financial stability. So I would then be more
confident in that
to
investment.
invest in them. But on the other side, let's say the dividend yield is too high, then it might actually indicate some underlying issue of the business. So
Okay.
that's something that I was like trying to
And
figure out.
I'm glad that you brought up about this, right? So maybe let's talk about dividend yield trap.
Yeah.
Right, there's this term called dividend yield trap. Maybe Willie can share with us what exactly is it, and how can investors actually avoid falling into such a dividend yield trap?
Maybe just to follow on from what Xin has mentioned about dividend payout. So I think dividend payout is actually one very strong point which I also tend to look at as well, like what Xin mentioned. And for myself personally, a good dividend payout ratio for myself is to look anywhere between 20 to 60%.
Okay.
Why is because I don't want to have the company pay too little dividends. That means the payout ratio is less than 20%. Otherwise, the dividends is not meaningful.
Yes.
Likewise, I will tend to be more careful or concerned if the dividend payout ratio goes very close to, let's say, 80 to 100%.
Too high.
Yeah, it's too high because what this means is that the company might not have enough cash to reinvest into their business to grow the profits in the business itself. So this is how I look at for dividend payout ratio. To your point on dividend yield traps, the dividend yield trap comes when you're looking at, stocks where they might have very high dividend yield or sometimes even double-digit dividend yield. Now, why is this a trap? Is because the dividend payout sometimes can exceed over 100%, or it can, the company might pay out most of their profits as dividends. A couple of reasons for this is, number one, the profits might have weakened or deteriorated, so it might have dropped.
Right.
But because the management or the company wants to maintain the amount of dividends which they've paid out, therefore, they will try to increase that payout ratio. So that results in, number one, a high dividend payout ratio, and number two, a high dividend yield. So this, to me, comes off as a potential dividend trap. And at the same time, if you see a lot of some of these companies, sometimes they might borrow loans in order to pay these dividends. So that's also another indicator which I tend to look at.
Yeah.
So for instance, on value traps, I did come across companies and I made mistakes before. One of them is actually a business trust. Many years ago, back in 2011 when it first IPO'd, and it had a yield of more than 10% every single year. And because that business trust owns containers, and during the shipping crisis, prices of container assets fell. So that resulted in a write-down of many of these assets. It also resulted in dividends getting cut, and the share price started to fall. And because of when the share price fell, the dividend yield started to
inflated.
Yeah.
Yes.
So this is one area which I tend to be more careful of. So it doesn't mean that high dividend yield stock means that all of these stocks are high yield dividend traps. I think we have to see certain indicators to determine whether these are high potential traps.
Right. So if I could sum up, it's more of like you don't just pay attention to only one thing, which is the dividend yield percent, but you need to make sure that fundamentally the company is actually still doing well, their profits, their top line, bottom line, right? And so the mistake that a lot of dividend investors make is just look at 10% yield and it seems very high, right? And they will just jump into that investment. Yeah.
Exactly.
Yeah, myself personally, I also like to make sure that the dividend per share, the trend is kind of stable or growing, slight growth over time or at least stable Even if right now the macro environment is challenging, then at least they are still able to kind of stabilize it and not see a very huge decline, right? So such are the companies which will likely to be able to sustain in their dividends payout. Just like you mentioned, you don't want them to borrow money to pay dividends, right? And that's definitely not sustainable down the road.
Exactly. I mean, it's pretty interesting. I mean, in the Singapore market, you can actually find some of these hidden gems. So one example would be, a grocery company called Sheng Siong. And, they are the third largest supermarket in Singapore. And what's interesting is that over the last 10 to 12 years, their share price have returned about more than 200%. What's more interesting is that it has been paying out steady growing dividends every single year. If you had looked at Sheng Siong 10 to 12 years ago and you have started buying its shares then, the yield on that cost would actually grow from about 3 to 4%. And today, you might be sitting on a 10% dividend yield on cost. So looking at high dividend yield, I think one way to look at is to look at companies where they are able to organically grow these dividends so that it grows your dividend yield over time.
Right. Early on, Willie, you also mentioned one point of reducing dividends, right? So something that I guess a lot of investors, they do not really understand or they do not appreciate is that the of companies giving dividends, actually it's not an obligation. Unlike if they go to the bank, they borrow money, it's an obligation to pay back the money. But giving dividends to investors is not an obligation. So it's not something that's mandatory. So during certain times, they may reduce the dividends or they may even stop paying the dividends totally. So when met with such a situation, how can investors actually respond to it really?
Maybe I'll just share one mistake which I made from investing in a Chinese developer listed in Singapore. So that was about 2 years ago. And, it was a great company. It was a great business. They sell property projects in China with very high profit margins. And one day, the management came out to announce that they decided to cut dividends. So every year they have been paying very consistent dividends. They have been paying about 5% dividend yield. And they decide to cut dividends. When that happened, that actually sent a signal for me to say that, okay, at this point, this is something which I would be a bit more careful because it's an indicator of a red flag.
Right.
Like, following what you say about management doesn't have an obligation to pay those dividends, right? But typically, companies, when they start paying dividends, they will tend to continue paying off dividends. Why? Because there's this thing called the client effect. Client effect means, right, when companies pay these dividends, they will continue to pay on these dividends because it attracts a particular group of investors like ourselves who likes passive income. And in some ways, this helps to support the share price, right? That's why if you see for dividend stocks, they tend to be more resilient in their share prices movement versus, let's say, growth stocks. So management will try their best to maintain these dividends unless something bad happens. And usually when something bad happens, they will have no choice but to cut these dividends. And it sends a signal or message for investors. So paying out dividends not only allows investors to collect income, but it sort of signals out, okay, what are the potential risks and dangers coming out from these companies. So the Chinese developer, which was listed in Singapore, after they cut dividends, the share price fell about close to 40% from then. And you can see that was how the market started reacting.
Right. So I guess it depends on whether the action of reducing dividends or stopping dividends is something that is like a more temporary or whether it's a permanent thing that has changed for the operations, right? Like to give an example, back during COVID 2020, I'm sure a lot of people could still recall many of like the REITs, right, the banks here, they say that they are going to reduce the dividends, right? But that was something that's more of a temporary thing so that they can actually have more resources at the sidelines, right, to get through the COVID period in case it continues to drag on further. But if, like the case which you mentioned, if let's say it's something to do with the operation themselves, right, that there is something wrong with the operations, then that is where investors would have to be very careful about whether they still want to be investing in such a company, right, for dividends.
So there's usually some telltale signs, like what you have asked about the indicators to look at. So it's the same indicators which I'll look at if the company has met with falling revenues, falling profits, they are taking on more debt than usual, then that is actually one telltale sign.
The red flags.
Yeah, that they might start to cut dividends or totally suspend those dividends. There will be times where quality dividend growers or dividend payers, they might temporarily reduce dividends, like what you have mentioned earlier. So these are some of the companies which sometimes I will still close one eye because there are businesses. At the end of the day, these are all businesses, and not all businesses are perfect. There will be some periods where there will be, where they make good profits, where there are some periods where, they aren't making much money. So what matters most is that they're able to have that kind of predictable profits even during downturns or crisis. And from there, we can sort of handpick and focus on what are more of the high quality dividend names.
When I speak to some retail investors on the ground during events, workshops, right, some of them will say, oh, I invested in a dividend company, right? And I initially thought they are very stable, right? Because that's what dividend stocks are generally known for, right? But after I invest in them, then I saw the share price crash by 30%, 40%, a bit similar to like what you mentioned earlier on. So were there such kind of instances where it deviates from your initial expectations?
Yes, I think there was one last year. So because I was like reading up on this stock Frasers and the PYTCH.
Okay.
So then, because I also know that they have like those AEM like initiative to upgrade their
Okay.
shopping malls and stuff. So I was like, it's not bad, I can try. So I went and invest. And then after a few months, it went up. But then after that, towards the year end, it went down. And now it's like quite not doing that good also. So that's something that, that actually, then it caught me thinking
Of
like,
God. Yeah.
Like I should maybe readjust my strategy or something like that.
So to that, Willie, do you have any advice?
I think this is perfectly normal. I also experienced that as well. I think first of all, I think is to understand that investing is a lot like trying to run a business. So business, there are two things we usually look at. Number one, revenues, and number two, cost. No business will have, will always be just making revenue and no cost. There will always be some cost, which means that in our dividend portfolio, it's good to diversify across, different stocks, because there will be some stocks which might not do well, some stocks which will do well. Why? Because if you look at the broader stock market, there will be different businesses, different stocks, which behave differently at different point in time, right? In 2005, in the mid of 2005 all the way to 2007, financial stocks were doing very well. In 2020, it was the tech stocks which are doing very well, but REITs weren't doing that well. So what you need is to balance out different stocks from different sectors, so that you are able to better accept, okay, if let's say a stock which I bought, share price drops, but overall, if the portfolio is still giving you income, the value of the portfolio continues to grow, then this is something which I'm able to accept and be comfortable with, right? As long as the business which you operate continues to make more money than the cost which you are paying, then I think this is a portfolio which is worth continue to grow and compound.
Right, and I guess sometimes in the short terms, right, share prices do fluctuate definitely, right, due to the sentiment changes in the environment. So important question is whether fundamentally, for example, talking about FCT, right, whether fundamentally it's still a sound REIT or a sound investment for you to actually hold on to. So I think that is very important over the long term. So the perspective also matters as well, right? Yeah, the time period. So when we talk about dividends, right, generally, Singapore markets is actually a rather attractive destination for dividend seekers.
Yeah.
So what makes Singapore markets attractive, and how does it compare to the other markets?
When it comes to investing in stock markets, it's either you want to drive a Ferrari or you want to drive a Toyota Camry. And for the Singapore stock market, it's more of like, okay, I prefer driving a Toyota Camry. You don't have to go really, really fast. You're just comfortable. It gets you to the destination which you want. And it's safe, right? It's safe, it's predictable. So this is the kind of investments which you can generally find in the Singapore stock market. I mean, like I've mentioned earlier, there are a couple of great names, right? Hidden gems in the market. It's not just Singapore REITs, it's not just Singapore banks, but there are also other companies which we can actually look at in the Singapore market. Of course, in terms of the ability to grow, it will be a bit different from the US market, largely because of the size of our market versus the size of the market in the other countries.
And also something that's attractive is that the dividends you receive here, they are not taxable, right? So you don't need to pay tax as an individual when you invest in such companies. Right? So that is something that's really attractive for investors to actually consider about. Right, so now moving on to this age-old debate where a lot of people say dividend investing is only for the older investors. So young investors should not look at dividend investing. You should go and focus on your growth investing. Now, I think Xin Yi yourself, you are still very young, right? So clearly, I guess you don't really believe solely on that because for you already started on dividend investing. So what's your take first, Xin Yi? Maybe you can share with us.
I guess it depends on what is the objective of my investment.
Okay.
And because I want to build a portfolio towards the long term and even retirement. So I thought that dividend investing is actually like a good start.
Way to get started.
Yeah. But then right now I also come across the issue whereby like, I thought that, in order for me to have like a substantial amount of dividend, I should have like an amount in my capital, like gain
a sizable
first.
portfolio.
Yeah. Then then it's better. Then after that, then move towards that. So that's something that I...
Okay. So really your style is pretty much focused on dividend investing, right? So what's your take on such a statement?
Okay, so based on capital, I think for dividend investing, you can start with a small capital as well, and you can start to actually build and grow it. One big misconception I feel is that you actually need a big capital to start dividend investing. For me personally, I think that when you want to get started dividend investing, the whole idea of dividend investing is to focus on three things. Number one, you're actually looking at the capital gains of the portfolio. Number two is to actually look at the dividend yield. And number three, where people tend to overlook is actually the dividend growth. So the dividend growth comes when you actually take a long-term approach. And this dividend growth is actually important because it allows you to say, okay, I want to start early, I want to start soon first, then I slowly compound it. You can get started with growth investing, but if you start looking at companies where they're already starting to pay you dividends and growing this yield, then you can have, both your cake and you can eat at the same time, right? You can have both the capital gains and you can have the dividend growth. I mean, if you see for Warren Buffett, he invested in Coca-Cola in 1980. Back then the share price was about close to $4. Today, the dividends which Coca-Cola pays is actually about $1.84. So that's a dividend yield of about 57% over a period of about more than 30 years. So, and at the same time, Coca-Cola has gained about 1,600% during this period. Now, why is this important is because you need to allow the compounding effect to take place. And the problem is that most people think that, okay, I'm probably just going to wait until I have a big capital, then I start investing in dividends. By that time, one problem is that we might accidentally start picking up the high dividend yield stocks. And that could be one potential pitfall. So rather than investing in such a way, why not get started investing early? Then you start picking up the companies which starts growing those dividends. Then you grow both dividends and the capital at the same time. So I think there's no hard and fast rule. I think for growth investing, there is a strategy. It really depends on how you see it. For growth investing, you are looking at, you need to have 50, 100 stocks, right? Because you are just betting on that 1 to 2 big multi-baggers, which could give you the highest returns in the shortest amount of time. Dividend investing, you are looking at more slow compounding, steady compounding of your returns over the years. And, you can contribute your capital as the time goes by. So you are just growing that capital over the long term.
Right. And personally myself, I also believe that actually even if you're young today, right, it is beneficial if you get started on dividend investing early. So there's no harm. It could be something like you allocate your capital accordingly. It could be, say, a 70-30, 70 in growth, 30 in dividends, or even a 60-40, something like that, right? But the objective of doing so is so that you can actually learn the craft along the way, because investing is actually a long journey. It's a marathon, right? It's not just a short race. So it's important that you need to slowly gain experience, learn how to pick the dividend stocks along the way, which will definitely help you. So if you start now, your future self will thank you at this moment in time, right? Yeah. Rather than like what you mentioned, at the point where you are going to retire, you need to do the pivot into dividend stocks, right? Then you realize, I don't know how to pick, right? Or I invest in the wrong company. And that can then set you back financially into your financial journey. So that is something that nobody wants to actually be in such a situation.
One of the most common mistakes which I get, right, is when investors starts to hit to their late 50s and 60s, then they start to think about dividend investing. By the time, what they want, right, is they want to actually start looking at stocks where they have very, very high yield. So they don't have, they always tell me, Willie, I don't have the time to actually start compounding and growing those dividends. Which can be a big pity, because if you see a lot of the high quality dividend stocks and the dividend growers, they take time to compound. And if you start to fill up, all of your entire portfolio with high dividend yielding stocks, there might be a chance where, you might actually step into a minefield or a potential value trap if you're not careful with it. So that's one of the reasons why, regardless of your capital, I personally feel that it's better to start as soon as possible. And this also gives you time to see whether you're comfortable with building, a strategy like this.
Right. So on top of this debate, right, about dividend investing is for the older investors, there are also other common questions that people have regarding dividend investing. So let's try and clear some of those. So one of them is a lot of people will wonder, so how big a size a portfolio do I need? Let's just put some numbers. Let's say on average, a month I want to have about $1,000. Although, yes, the dividends are not distributed monthly, but let's just average out a month about $1,000. How can they actually do the math to calculate the portfolio size to get something like that?
Okay, that's a very good question. Also a very common question which I get. So my straightforward answer is you simply take $1,000, you multiply by a full year, which is 12 months. So that gives you $12,000. And if you look at the stock market today, if you're looking at stocks which are yielding between 5 to 6%, that would require to have about roughly $200,000. Now this might seem like a huge mouthful, especially if you started working or you don't have much savings first. On the flip side, I think what's more interesting is this alone just gets you the instant dividend yield. But if you think about this, when you're looking at dividend investing, sometimes we ask ourselves, right, do we really need those dividend income, when we first started working, right? Sometimes the answer might be, okay, I want to reinvest those dividends. So because of this, instead of having a much larger capital, I can actually tell myself that, hey, I don't need $200,000 to achieve that $1,000 a month dividend. Instead, I can start off by investing, let's say, $50,000 into the stock market. And I contribute every month my salary to grow that portfolio over time. That serves me two things, like I've mentioned earlier. Number one, you grow the value of your portfolio. Number two, you invest in stocks where they grow those dividends, and those dividends will eventually grow to $1,000 a month of income. So what you are doing is you are trying to delay the gratification of getting instantly that $1,000 a month. What you're doing is you want to try to grow it gradually.
Right.
And with the luxury of time, this allows you to build a more solidified stock portfolio for yourself.
Right. So you mentioned about reinvesting, right? I guess that's something that people also wonder, should I reinvest it or should I, take the cash out, the dividends as cash out? So you brought up a very good point, right? So if you are early in the stage, let's say you just started working, so you have a small portfolio size, then that's where you can consider reinvesting them, right? So that you can compound your portfolio faster. But of course, if you're already retiring, you need the money to pay for your living expenses, then no choice, you have to take out and use it as cash, right, to cover your living expenses.
Yeah.
So it is actually possible for someone to live off dividends. Would you say so?
So this is a very age-old term which we have commonly hear this over and over again, because back then there was the internet just started. There wasn't really internet, and the only way to really build passive income is via dividends, right? But today there's so many other ways to make passive income, and I think the biggest question we need to ask ourselves is what is our goal or financial goal or target here? And I think from there, then we try to answer ourselves how much dividends we want, right? So one example which I can give is, I do have a member, right? And what's interesting that he came to me for help one day. He said, Willie, can you help me to grow my portfolio to $20,000 of dividend income a month? Yeah.
Okay.
Yeah. Right. And then I asked him, how much are you getting now, and why do you need so much dividends? And he said that, he has about $2.5 million in his portfolio, and he's already getting about $10,000, between $9,000 to $10,000 of dividends. And I said, why you need so much? I just say that, I just want more because, I want to live more. I have to sustain my car. I have a big mortgage to actually feel, I have a big family, so on and so forth. So it really depends on individuals, how much is actually enough for you. I think one story which I will never forget, and this is something which I read a couple of years back. So it's a story by John Bogle. So he was the founder of Vanguard. I mean, he has already passed on. And what was interesting was he shared this story of two very famous authors. So these two authors, right, they joined this rich billionaire friends party. And the billionaire is a hedge fund manager. So at the party itself, both of the authors, right, they are both good friends. One of them said to the other, he said, hey, our friend here as a hedge fund manager makes so much more money than the books you are actually selling. And to which the other friend author replied, he said, yes, but he has something that he has, I have something that he will never have. And the authors asked, what was it? He said that I have enough. So there's one more thing which we need to understand is what is our goal or target do we want for ourselves, right? Do we want to drive a Ferrari or do we want to drive a Toyota Camry? I mean, there's no right or wrong, but it really depends on your individual preference. And once you think about that, it's easier to work backwards to answer the concept of living off from dividends. And I think it's also pretty interesting because sometimes living off dividends doesn't mean that I invest for dividends and then retire entirely. Sometimes it's about trying to make a career transition. I built a portfolio so that I can actually do something else which I want with my life. And that was what I did, right? When I started my career in finance, I started saving and investing. And in 2018, I decided to quit. After saving and investing my portfolio, I realized that, okay, I have enough income to tide me for a while. Why not do something else? And then I switched over and then I started writing a blog and I do something else with my life. So it really depends on the goals which you want for yourself, how you want to do it. It might not necessarily mean that living off dividends entirely means that I want to, okay, I have a portfolio and I just, retire off into the sunset. Because, after writing and talking to many investors over the last couple of years, it's interesting that even after they built their portfolio, many of them still continue working. And what was even more interesting is that as they work, they are able to take the income and grow that portfolio itself. So one big takeaway was the dividend portfolio allows you to take a break. It allows you to transit from one career to another. And one of the most thing which really hit me hard, right, was when he's like a member in my community, right? And I asked him like, hey, why do you want to build a dividend portfolio, right? So and say, why do you need this passive income? Because his background is, he's still working, he's comfortable and all that. And he replied me something which really, really hit me. He said that he actually wanted to build this portfolio for their daughter, and the daughter is actually an autistic. And they're worried that after she studies, she goes out into the workforce, it's difficult for her to get accepted into society because it's not easy to find a job. As a result, they actually wanted to build a portfolio so that it allows her to supplement some income for herself. And when I think about that, it never really hit me because I always thought that investing is all about, okay, you try to maximize your returns and try to make a lot of money and all that. But sometimes it doesn't really have to be that way, right? Some people, they build a portfolio so that they can supplement income for their family. Sometimes it could also be, I have this reader who has undergone who was hit with cancer, right? And she had no choice but to stop work. And she can only do that if she can only do that with a portfolio, right? Because she wanted to build a portfolio so that when she stops work to treat her illness, she has some income to sustain her. And obviously she doesn't want to tap into her savings. She doesn't want to see her savings deplete. As a result, she found another means of building that passive income. So there are many different ways to build passive income. Property investing, like what Xin has mentioned, you can start a side business and all that. But nothing comes close when, you might be physically not mobile. You have no choice but, to stay at home. And for me personally, the most optimal way to build income at the comfort of your home, if you're immobile, is through investing. And after hearing many of these stories, right, it made me think about investing in different light, right? You see people's objective very differently. So it's not just about living off dividends entirely.
Yes.
It's so many other
Yeah, but it gives you a freedom of choice where you can decide what you want to do with your life. Right, like you mentioned, right? So it's not, I retire, I do nothing, but then I can go and work on something that I really like my passion, right? And pursue something that I find meaningful rather than just work for something just for the paycheck, right?
Yeah,
So
exactly.
that gives us then the freedom of choice to live our life in the way that we want to.
Yeah.
So just like what you mentioned, the examples, right? So those are very inspiring stories. Yes.
Yeah.
Right. So Xin Yi, yourself, do you have any questions regarding dividend investing that you want to discuss with us?
So I have one question regarding is it better to invest in the dividend stock individually, or is it better to invest through ETF that pays out dividends?
Very good question. And I would say do both.
Okay.
So you don't have to buy both ETF and dividend stocks immediately, but you can work your way towards a diversified portfolio of different sources of dividend stocks, whether if it's from REITs, from dividend paying companies, from ETFs. The most important thing I personally feel is to have a goal first. Think about the capital which you want to achieve. And then from that, think about how you want to diversify. You slice up your portfolio, think about how you want to put the different asset classes which are able to generate you that income. So it's not really a zero-sum game because as a dividend investor, as a young dividend investor, you are still contributing money into the portfolio. So you can actually have the flexibility of putting money in both ETF and dividend stocks, and you can grow them, gradually over time.
And I guess it also depends on the level of skill sets that you have at this moment, right? So for someone who is totally new to investing, right, you don't even know how to go and analyze the businesses, then definitely ETF would be a great choice for you to get started, right? But if you're someone who has the skill sets, you know what to look out for, like the metrics that we talk about, right? How to analyze companies, then individual stocks could be an option that is then available for you to actually look at. And also sometimes certain people just don't like to be self-directed investors. They just don't like to do DIY, right?
Exactly.
Yes, then for those group of people, definitely ETFs would be the better choice. But if you're someone who has a passion to look at companies, to understand them further, then individual dividend stocks would be a great choice for you. So a lot of factors. So at the end of the day, it depends on that investor himself or herself, like your skill set, your level of interest, the time that you have. Some people are just too busy in their career that they don't want to analyze the companies. And well, that's understandable, right? Also. So yeah, really depending on your circumstances as an investor. Any other questions that you have, Xin Yi, on?
Regarding reinvesting the dividends, right? How can I better reinvest so that it can maximize the?
So usually what I would do is I will actually have a watch list of different stocks, and I will usually track what are, at that particular point in time, what is the most attractive dividend yield, what is the most attractive price to actually buy the stock. And as my dividend starts coming in, I will reinvest according to that watch list itself. So for instance, right, if the banks today at DBS when it's more than $46, if you ask me, would I invest in it? Yeah, maybe, but would it be the best way to maximize my returns? Maybe not so much. Why? Because if I look at other opportunities, like let's say REITs, REITs have sold off since the start of this year, and they might offer more compelling, more attractive returns. Then I might actually put this dividends which is coming in, I can reinvest to some of these REITs. So it depends on the opportunities at that point in time. What I will do is I will try to be prepared. I will shortlist what are some of the stocks which I really like, but might not be the best time to buy it. And then I just wait, right? When the dividend starts coming, then I just deploy accordingly. So it's a lot like, trying to play chess and try to think strategically, what is the next move which I want to make? And the beauty of this is you don't have to monitor the market every single day, right? You can have this watch list, and then once you actually invest into these stocks or these businesses, You can just sit and you can just relax, and you can just update yourself with the financial data maybe every half a year or every year, because knowing that you have already done through the assessment, you know that okay, this is fundamentally a decent company, it's a good company. I don't have to monitor it every day, right? If you invest in private business, right, you don't really have to go down to the store every single day to see whether it's making money, right? And you just need to look at the financials, on a regular basis.
Right, exactly. I actually resonate with what really you have just said, right? It's about identifying the opportunities that are good at this point in time, so that every dollar that you reinvest, right, is really put to good use. So, for example, you mentioned REITs, right, which could be at a very low valuation at the moment in time, then that is a compelling opportunity to actually take advantage of, to redeploy every dollar of dividends that you want to reinvest in. Right? So at the end of the day, it's like looking at both your risk to rewards. But what a lot of investors like to look at is only the returns, right? How much can I get? Oh, it has gone up by 20%, so it's going to go up by another 20%. That's what people tend to do, right? They just kind of extrapolate the returns and think that's the way to get better returns.
I think that's interesting. So what I've learned over the last 14 years of investing is that for dividend investing, as long-term investors, we might not be the best investor in a rising bull market, right? So we might not outperform the market, we might not get a maximum returns. But I think what we are really good at is being able to manage the bear markets. That means when it comes to a market sell-off, typically, if you've done it right, you should have a portfolio of very stable businesses, companies which are able to weather through some of these economic downturns. So that's one. And number two, dividend stocks, they tend to be more resilient in terms of their share prices versus growth stocks, for instance. So that helps you to see more comfortably whether, if it's in a good market or bad market. So being able to control the risk is something which, as dividend investors, we tend to have a much stronger advantage.
Right. So as we approach the end of today's conversation, right, Willie, what is one final action step that you want to share with young investors who are looking at dividend investing?
I think the first thing before we get started investing is having the mindset first. So it's a lot like trying to empty your luggage first before you check into the airport. Because if the luggage is overweight, right, you can't go into the airplane. The person will tell you to remove the excess baggages in the luggage itself. So it's the same thing for investing, right? When we approach investing thinking that it can make us quick gains or quick wins overnight, right? It's very hard for us to think long term. And one of the biggest paradigm shift is actually thinking about how we can actually shift our mindset from more of a short term thinking more to, okay, long term, what do I want to achieve? And then how do I actually go about doing it?
Right. And for Xin Yi, how has today's conversation offer you any new perspective or insights on dividend investing?
I guess after this session, I gain more confidence
Okay.
in terms of dividend investing, but also know what are some of the thing to look out for in terms of value trap or whatever. But also reinvesting my dividend is something that I will potentially look at.
Okay, that's great to hear, and really great to have both of you joining me today, right, to talk about dividend investing. And I'm sure all these insights that we have unpacked would definitely be helpful for our audience who's tuning into this episode today. Right. Okay, so is dividend investing only just for the retirees? Not really. It is a solid strategy that's suitable for any age as long as it fits with your investment goals and objectives. So if this episode has changed your initial perception of dividend investing, let us know in the comment section below. Until next time, keep a FOMO in check, stay informed, and happy investing. Catch us again in the next episode of the FOMO Fix. Right, thank you, Willie and Xin Yi.
Thank you. Thank you so much.
If you're feeling fired up and ready to dive deeper, feel free to hit us up. Leave your comments below. We would love to hear your questions and topics that you would like us to cover in future episodes.